Okay, we have a bunch of people coming in fast and furious right now. We'll start in a moment or two. We're at 11 o'clock, so we don't have it's still, people are still filing in, but I think we'll just start the ball rolling. Greetings, everyone. Welcome to Retirement Income Journal's webinar, Seeking Certainty with Defined Outcome ETFs. We're going to be talking with Graham Day and Joe Becker of Milliman and Innovator. And we're going to be talking about these defined outcome ETFs. If you don't know what they are, these are structured products that deliver protection on the downside and generous but capped outcomes on the upside. And these are sort of the hottest things right now. The structured products are still a mystery to a lot of people, but they are an answer for a lot of what ails investors right now in terms of uncertainty. And so this is what we'll be talking. The products have been out for a couple of years. I'm going to let our capable panelists explain what that is, and let's get into it. The panelists can introduce themselves better than I can, and we'll go in alphabetical order with Joe Becker and then Graham.
All right, well, thank you, Kerry. Thank you for having us on here today. My name is Joe Becker. I'm with Milliman Financial Risk Management. I am a product strategist, a portfolio strategist with Milliman. And Milliman is participating in this today because we are the sub-advisor for the Innovator Defined Outcome ETFs. Milliman has a long history of portfolio management, specifically focused on risk managed products. And so this was an ideal partnership for us. And we've been glad to be able to be a part of this. And prior to coming to Milliman, I was at Invesco, where I was also an ETF strategist. So it's been great to continue this work with Innovator. With that, I'll hand it over to Graham.
Well, thanks, Joe, and thanks, Kerry. Again, my name is Graham Day. I'm with Innovator Capital Management. Been with the firm really since the start back in 2017, and I'm responsible for the product side of the business here. And so I think, taking a step back, my background is also similar to Joe's. Started at Invesco Power Shares over 10 years ago, and so has spent my entire career in the ETF space. And we're really excited to talk to you about our defined outcome ETFs, because they offer something we think that's been available in other wrappers, but we think the ETF wrapper is something that adds particular value for the end client.
Okay, let's talk a little bit now about why these products are important now, which requires just a quick refresher on the market and environment, and we can move that into that.
Sure. Yeah. So just quickly to set the table for our discussion today, a few slides talking about the current market environment and really focused on the risks that exist today. This chart just shows, many of you have seen something like it, I'm sure, just how high current market valuations are. And Graham, if you want to jump in on this as well, do feel free. But the thing to point out here is that even if you take into account yield levels, right, on the 10-year today, we're about 175, even factoring in for these low yields, PE multiples are at a 25-year high, right? And so we have to ask ourselves, how is this going to resolve? If we expect reversion to the mean, is that going to come through higher earnings, or are we going to see multiple compression? And so this is something investors have to grapple with today. This chart just shows that yield really is predictive of future returns in the bond market. And what it's looking at specifically is looking at the starting yield and then the subsequent total return, annualized total return over the next like 7 to 8 years, which is the average maturity in the Barclays Ag. And it shows that as yields have come lower, total returns have also come lower. And so we have to ask ourselves today, at these very, very low starting yields on the Barclays Ag of below 1.5% yield to maturity, what can investors really expect from their bond portfolios going forward in terms of return? And we think the returns are likely to be very low if history is any indicator. On this slide, we want to really highlight that as yields have come down, right, the reward has diminished over the years, but the risk has increased. And by risk, we mean specifically the duration of the broad US bond market has gradually ebbed higher, so that today the risk reward trade-off in bonds has really never been worse than it is today. And so you can see here that really the upside potential, if we assume a zero floor, right, if we assume that the ag bond yield won't go below zero, investors have a little more than 1% for bonds to fall, right, and to generate price appreciation. But look at all that upside that rates could go and how far that could push bond prices down. And so it's really a follow-up to the previous chart that the risk reward, the trade-offs that investors are making today with bonds, really they really have to kind of think about bonds differently and how they've used them in the past. Graham, anything you would add to that?
Yeah, Joe, I think something to point out too is I think that the first time in at least 3 or 4 years where investors are starting to realize I can lose money in bonds again. And what we'd like to show is that over the last just year to date, core bonds like the ag have lost around 3 to 3.5%. But if you look at the yield to maturity on those bonds, the yields have really only moved up 20 or 30 basis points. And so if we were to ever get back to a level of not just 1996 yields, but 3-4%, you're going to find a situation where investors are going to have expectations that were not met. That bonds they've always thought are super defensive and they can't lose money, but they can lose money. And we're starting to see that. And so I think people are starting to reevaluate, what is the purpose of my bond portfolio today? Am I going to get returns that I used to? No, I'm not. So what is that? What purpose is it going to serve in my portfolio moving forward?
Yeah, the increase lately has felt big. The 10-year move up has felt big, but as recently as 2010, the 10-year was trading at 4%. So we could have another 200 basis point move in theory, which would be very painful for bond investors. Part of the increase we've seen has no doubt been attributable to inflation expectations. This is the bond market's inflation expectation, right? It's the difference between the nominal treasury yield and the TIPS treasury yield. And this increase here that we've seen just this year, end of 2020 and into 2021, is the biggest increase really since before the financial crisis. And so if these expectations continue to rise, and if they prove to be accurate, that is really going to hurt bond investors with interest rates and bond yields pushing higher.
Yeah, and Joe, something else that maybe to point out too is on these inflation expectations, the ramifications for both bonds, which naturally are the first thing that comes to mind when inflation is rising. We know that means nominal yields are moving up. That means bond prices are coming down, but there's also implications for stocks. that historically in rising inflationary environments, you don't tend to see as strong as equity performance in those environments. And so, I think this is really one of the things that Joe and I, as we're talking to advisors about, is it's a double-edged sword of you're faced with both low expected bond returns moving forward, but if you're faced with lower than what we've experienced equity returns, that poses a problem. And so that's something that we're having a lot of conversations with advisors around today.
Mm.
Then the last slide, just in terms of setting the table here, is the Fed really has been behind so much of what we've just looked at. And this slide, every time I update it, it's astounding to me just how much it changes. This slide really compares policy pre-crisis to policy today. And if we look on the left-hand side, that's looking at the average policy rate of the Fed, the European Central Bank, and the Bank of Japan. 3.5% back in 2007 versus today, we're looking at 6 basis points as of the end of 2020. And then really over here is the more kind of astounding stat in my mind, just how much the Fed balance sheets have grown. 3.3 trillion at the end of 2000 or in June 2007, having grown today to $21.7 trillion, representing more than half of the 3 GDPs. So the question really is, can investors rely on the central banks to come to the rescue? How much longer before the Fed has really spent all its ammo? And I think the implication is that investors today need to be thinking more about taking on risk management themselves and not relying on the Fed to sort of act as a market backstop, to act as the put to save investors. Because the more they do this, the more it dilutes their ability to affect markets. Mm-hmm. So that brings us to the end of our sort of setting the table, and we can shift now into the next section of our presentation. Graham, I'll hand it to you.
Well, thanks, Joe. And so one of the things that we like to, as we set the stage for the defined outcome ETFs, is many of you are going to be familiar with the concept that we talk about here. And that's this idea of having a known outcome prior to purchase. These payoffs have been available in insurance wrappers, in bank wrappers for decades. But one of the things that we're really excited about is to take these payoffs that we know add a lot of value to clients and put them in the benefit-rich ETF vehicle. And so what are defined outcome ETFs? Defined outcome ETFs are very simple. They give you exposure to a broad market like the S&P 500. And in exchange for a performance cap, you will have a known built-in buffer against losses. Our ETFs offer buffers against losses of 9, 15, or 30%. And then it's all over a 1-year outcome period. So at the end of each outcome period, unlike an insurance product or bank product, the ETF doesn't just come due and you get a cash distribution of whatever the value is. The ETF will rebalance. And because of that, the ETF rebalancing for you, there's a huge value out of the tax efficiency of these ETFs, that there are no tax distributions for the advisor until they choose to sell, when they choose to liquidate. And so we think that is something that is extremely valuable. There's no credit risk with these ETFs. And like any other ETF, you can buy and sell on the exchange. And we'll talk a little bit more about the structural benefits of these products. But we started first with the S&P 500. And as I mentioned, providing ETFs that buffer investors against losses of 9, 15, or 30% and give them one-to-one upside to the S&P 500 up to a performance cap. Now, those performance caps obviously will range based off of the buffers, and we'll touch on that in a little bit later. But we've since expanded this lineup to encompass more than the S&P 500. We've expanded into the NASDAQ 100, international markets, emerging markets, to provide investors a wide array of tools that they can use to manage risks in their clients' portfolios, known risk management too. So I think that's something that we like to talk about. When you think about ETFs in general today, there are no ETFs out there that you can purchase and know with certainty how much buffer you have in place. These ETFs are different. You can know you have that buffer in place against losses. So if the market falls 15% in a 1 year time frame and you have a 15% buffer, there's no, you know what, it didn't work this time. It's there, it's known prior to purchase, and that buffer works. And these ETFs, we've completed over 40, 50 outcome periods, and each of these ETFs have done exactly what they said they were going to. And so really, one of the things we like to talk about is it adds certainty for the end investor. Certainty of knowing upside participation levels and whatever buffer levels they have prior to purchase. So here I kind of set the stage for this slide. And this is really what we offer on the equity side of our buffer ETFs. A 9% buffer, a 15% buffer, and then 30% buffer. And you'll see in the second row of these tables what the average performance caps have been. So I mentioned the word performance cap or upside cap. And what all that means is that you will participate looking at that 9% example, that in exchange for a 9% built-in buffer over a 1 year period, on average, our ETFs have provided a 17.6% upside participation, meaning if the S&P was up 15%, you would participate 1-for-1 up to 15%. If the S&P was up 25%, you would be capped at 17.6%. And then conversely, with the markets, if they dropped 10% in a year, you would be buffered against the first 9% of losses and then participate in that next 1% loss or losses moving beyond that 9%. You can see again here the average caps in the middle for S&P 500 are 15% buffer, as well as EFA, emerging markets, Russell 2000, and NASDAQ 100. And so this hopefully illustrates our attempt to provide a wide array of tools for advisors to build portfolios that have risk management built in to them. And then finally, so the 15% buffers against the first 15% of losses. And the 30% is a little different. The 30%, you take on the first 5% of losses, but then you are buffered from -5 to -35% over a 1 year time frame. So this is really for people that are concerned about a major market correction, something like we experienced in March of 2020, but maybe if that had been extended longer, or a better illustration might be 2008, when the market was down 37%. If you had had this type of product, you would have been buffered against 30% of those losses. And so if the market was down 37%, you would take on the first 5% of losses and the last 2% of losses. So you'd be down 7%. And the average upside cap with this strategy has been around 7.8%. And then again, something to again point out is, unlike other wrappers, these ETFs simply rebalance at the end of the outcome period. And so if you want to buy and hold for a year, 2 years, 3 years, a taxable event will occur only when you choose to sell and not before. And so it's the outcome is really at the advisor and client level as opposed to the structure level. And so I think that's something that is worth pointing out. This is the largest lineup of defined outcome ETFs in the market today. We recently crossed $4 billion in assets. And so really feel that this provides a solution to the problems or potential problems that Joe's illustrated in the previous section of bond yields being at record lows, equity valuations at all-time high. Where do you put your money? Where do you put your clients' money in this type of market today?
I'll just jump in quickly and say on that 30% buffer with an average cap of 7.8%, right? Talking about how investors have used bonds for protection historically, but have historically also gotten meaningful returns. This may be something to consider as a potential bond replacement with that deep buffer, that deep level of protection, but an average cap that right now is about 4 times the yield of the Barclays Ag. So that's one way we've been talking about using these products. But Kerry, I'll hand it over to you with that.
Yeah, I just wanted to, I had to unmute myself there. I just wanted to look under the hood of these risk management techniques a little bit, so that we don't need to go into too much of the gnarly details about the puts and calls. But let's give people some idea of what your options budget is, and how this they help you set up the upside and the upside cap and the downside buffer, where those guardrails come from, how they change over time, and because that will be one thing that the people will be watching, how much these are in the money and out of the money, right? But let me not get ahead of you. Let's just talk about the risk management technique and the setting of the boundaries.
Yeah, Kerry, that's I think a really important thing for us to touch on. And how we construct defined outcome ETFs is different, I would say, than many other risk management techniques that may involve, rotating between cash or bonds, and maybe reducing equity exposure, raising some cash based off market signals. We don't do any of that. Although people can sometimes, when they hear that, hey, these use options, this must be complicated. In my 10 plus years of building ETFs, these are probably the most simple ETFs that we've been a part of building. And why is that? It's at the end of the day, when we build these ETFs, we're using a basket of options, and we'll touch on this, but really as few as 4 options positions. And once that portfolio is built, it is fixed for the entire outcome period. We are not changing strikes. There's no portfolio management that's involved at all with these products. And so what that does is it provides a defined outcome for advisors. And so what do? We talked about S&P 500, for example. And what we'll do is we'll just buy a simple 1-to-1 exposure on the S&P 500. So for those that are familiar, a deep in the money call. And that's our first layer of exposure. And we like to explain, there's 3 layers of exposure. Your first layer is a deep in the money call, which again, it gives you 1-to-1 exposure on the upside and the downside to the S&P 500. With that layer, we get the implied dividend yield of the S&P 500. So let's just to simplify, let's say that's 2%. So with layer 1-to-1 S&P 500 exposure, and we get the 2% yield on the S&P 500. What we do with that 2% yield is we take it and we purchase the downside buffer of 9, 15, or 30%. The problem is often that buffer is more than 2%. So let's say the buffer costs 3%. Well, that's where the third and final layer comes into play, and it's the upside performance cap. And we'll go out to the market and we'll bid it out to market makers and say, who will give us the highest call possible that we will sell, the highest strike call, and that will set the performance cap for the 1-year outcome period. So using this 9% example, the average cap of being 17.62%, that's where we're selling that call. And so again, layer 1-to-1 upside exposure, downside exposure to the S&P. Layer 2 is the 9, 15, or 30% buffer. And layer 3 is the call that we sell to finance this so that it's a zero cost options strategy. So again, compared to many bond strategies or equity strategies that are rotating between hundreds or thousands of stocks and bonds, and there's portfolio managers, there's levers being pulled, there's nothing like that here. Once that basket is set, it is fixed for the entire year, and we do not change it until the end of the outcome period. And at the end of the outcome period, when those 1-year options are maturing, we simply roll them into a new basket of 1-year options. We reset the buffers at 9, 15, or 30%, and then we'll strike a new upside cap. So the only thing that will change from outcome period to outcome period is the upside performance cap, and we will provide the highest cap possible that the market is giving us.
Well, I think we've got some other slides to get to, so let's go after them.
Yeah, so this simply lays out what can you expect from a buffer ETF. And so again, unlike most other investments where if someone asks you if the market's going to be down 10%, what are you going to get? The answer is, I have no idea. What these ETFs do is they narrow the set of potential outcomes so your outcome can be known prior to investing. And so this is, again, laying out exactly what you can expect to receive from these products. Let's maybe start at a major sell-off. If the market is down 30%, again, with our 9% buffer, you would be buffered against the first 9% of losses, and then you take on the last 21%. The power buffer, or 15% buffer, you'd be buffered against the first 15% of losses, and then take on the last 15. And then, as we mentioned, with the ultra buffer, you take on the first 5% of downside, but then are buffered from -5 to -35. So in this case, you would be down just 5%. You can see that as that in a normal market condition, market correction, the buffers of 9%, 15%, and the ultra buffer, you can see what you would be down in those markets. And then on the upside, these ETFs will participate in the growth of whichever market they track. So if it's the S&P 500 or the NASDAQ 100, and you will participate 1-for-1 up to that performance cap. So if the market's up 7% on average, our caps are, as we outlined in the previous slide, but in this scenario, a cap of 15, 10, and 7 for our buffer, power, and ultra buffer, you would match the performance of the S&P 500. In a high growth market, if the market's up 30%, you would hit your performance caps of 15, 10, and 7. So a good way that we talk about this is if you are planning your clients' futures, are they more concerned about getting 30%? Or are they more concerned about losing 30%? And so providing that level of certainty to investors, to the clients, and knowing, setting expectations prior to investing is something that we think is incredibly valuable. Now, this is a slide that how do these ETFs perform during the outcome period? That's definitely a question that we get quite often. And because these are options and they're 1-year outcome periods, it's important to note that these ETFs during the outcome period, they won't track 1-for-1 with the underlying. And so what I mean by that is, in this example, we highlight the S&P 500 Power Buffer ETF. It's our 15% buffer, and this is our April series. So it provides a 1-year defined outcome from April 1st of, say, this year to April 1st of the next year. This is actual performance of the strategy for the 2019 to 2020 outcome period. And as I mentioned, because these are option strategies and these will 1-year outcome periods, you will not track 1-for-1 on the upside. You won't realize that full performance gap until the end of the outcome period. And the same applies on the downside buffer. But a good way to look at this is you will generally track with the performance of the underlying during the outcome period. And here, again, this looks at an outcome period that concluded at the end of March 2020. So right at when COVID had just hit, there's a ton of uncertainty in the market. You can see that prior to the market drawdown, these ETFs participated in the growth of the market and almost hit the performance cap of 10.6%. And then we all know what happened at that time, the market sold off 34%. But you can see that if you were an investor in this ETF, your experience was far more muted than the market. And then at the end of the outcome period, this ETF, which we said would buffer against the first 15% of losses, buffered you against all the losses of the S&P over this time frame. So really, it's a boring strategy. It's you can participate up to that 10.6% cap, but also have a known buffer of 15%. It's a smoother ride, and I think that's what a lot of investors are looking for in this type of market.
Boring is the new good. Okay, let's. These are the buffers, right? Oh, I think let's just clarify for people that the difference between a buffer and a floor, just very, very briefly, and then we've still got some things to cover here.
Yeah, Kerry, I mean, the buffer and the floor. So a buffer is a known amount of protection over a defined level. And so the buffer, say a 15% buffer, that means you will be buffered against the first 15% of losses. Now, if there's a floor, what's a 15% floor? Well, typically a 15% floor means you take on the first 15% of losses, but then, you take on the first 15% of losses, but that's your maximum amount of loss. Mm-hmm. And so a floor, you maybe take on the first amount of risk, but then you're protected against catastrophic losses. And then the buffers are, as we said, the first 9 or the first 15% of losses.
Yeah, when these products were first introduced, I thought, well, aren't people going to balk that they have the that they handle the tail risk, and that was 10 years ago, and it hasn't been a problem. It really has not been a problem with the customers or the advisors. We've been 10 years into the dissemination of these at least on the insurance side of these products, and they've done very well. Okay, well, I know let's get back to it. We have a couple more important slides here to get to.
Yeah, I think with this slide, we just like to highlight the benefit of knowing you have a buffer versus hoping you have a buffer. And so strategies that a lot of advisors have used for a long time, maybe something like low volatility, where they're constructing their portfolios and they're saying, what has low vol done in previous market drawdowns? Well, in previous market drawdowns, it had maybe a downside beta of 0.4. And so if the market is down 20%, maybe I'm only going to be down 8%. Well, it works until it doesn't. And that's the benefit of the built-in buffers, is there is no, how has it performed in the past and will it perform the same way in the future? It's knowing you have a buffer in place and that you will be buffered against losses. And so this is looking at just calendar year 2020 performance. And yes, the S&P finished the year up 16%. You can see 2 of our January series ETFs, they hit their performance caps, 7.7, 6.9. And, min vol caught up a little bit. Low vol did not. Something that uses a 200-day moving average, a switching strategy was down on the year. But I'd like to draw your attention to the max drawdowns, where something like min vol and low vol experienced the same, if not more, downside. And so they didn't do what they said they were going to do. And it's because you're hoping that strategy is going to work versus knowing. And I think that that's the benefit of using these ETFs, that PJAN buffered against approximately 14% of losses during that max drawdown experience. So even though it was only 3 months into the outcome period, you realized almost 14% of your 15% buffer. And then UJAN, you were only down 14% versus the market being down 34%. And so that's where we see a huge value add of knowing you've got risk management in place as opposed to hoping. real briefly, we're asked because these ETFs, they trade on the exchange. And so again, people are not used to seeing these payoffs being delivered in a highly liquid vehicle like the ETF. How can I know that these are actually liquid? Well, with any ETF, an ETF will be as liquid as its underlying components. And so you'll see that the reason why we brought defined outcome ETFs on the S&P, on MSCI, on Russell 2000, because these are the most liquid and they have the deepest pool of liquidity in the markets today. And so if you look at something like the S&P 500 and just the S&P 500 ETF, there's over $800 billion of open interest. It trades $140 billion in the options market every single day. And so if you're concerned about trading in size or wondering, well, how am I going to get in and out of this? These ETFs are liquid, not because they're ETFs, but because they hold options on the most liquid underlines in the world. And so if you have concerns about trading in size, hopefully this slide alleviates and we can demonstrate the ability to move in and out of these ETFs with ease.
Remember this next slide, I don't know if you've been looking at the Q&A, but there have been a few questions that have come in about that talk to kind of some of the points of this. So, hopefully for those of you who have asked, this will address them. If not, we can definitely tackle those later. But Graham, if you want to work through that.
Yeah, and Joe, I haven't been keeping track, so if you want to keep me
Sure.
on track to answer as many of these questions. But I mentioned earlier, we have not created anything new. There's no silver bullet. These payoffs have been around for decades. But when you introduce these types of buffer payoffs, defined outcome payoffs in the ETF wrapper, we think there are enormous benefits, not only for the end investor, but for the advisor. And that makes the advisor's life a lot easier. What are some examples? Well, we know, having talked with many advisors, that if they're using, say, an index annuity, they have to go to each of their clients and get client signatures before they put that in place. And they have to explain credit risk. And then they have to explain that, this isn't going to report right alongside all of your other stock and bond investments. And if you want to get out, there's a surrender charge, and there's a lot of there's multiple levels of explanation that have to go in to talking through not the payoff, but the wrapper. And what the ETF does is it eliminates those complications. It simplifies the story because these ETFs, there is no credit risk with these ETFs. The counterparty behind them is the Options Clearing Corporation, the OCC. They have never defaulted. So there's no Bear Stearns or AIG behind these options. You own the end options. If you want to purchase these ETFs, you can purchase them in a block trade, for example. And what I mean by that is maybe you have 30 clients that could gain a benefit from implementing this exposure. And you can go and you can buy a block of, say, 100,000 shares and simply allocate that one trade, 100,000 shares across all your clients at the same price. You don't have to go client by client by client. And then there are no surrender charges. There's a competitive secondary market for these ETF shares. And then these are tax efficient. If you come to the end of the outcome period, or if you have another structure that's being delivered to you, when that product comes due, it is a taxable event, or a taxable event begins. With these ETFs, if you realize a defined outcome over 1 year and you say, you know what, I like the upcoming new cap, and I want to maintain this 15% buffer, you don't have to sell. And because of the benefit of the ETF wrapper, there won't be any capital gains distributions. And so you are in control of when and if you want to sell, and when you will realize any sort of taxable event. So, Joe, I went through a few, but let me know if I missed some.
I think the audience wants some clarification on. We know that they're liquid, and I think that they want to know: do the caps and buffers apply throughout the period there, I think they might be thinking of indexed annuities where you have a lock-in once a year. This is completely different, right?
It is different. And so, I mentioned before, maybe a way to think about it, or an analogy to draw, is it's like a bond. A bond, or one of these ETFs, is issued at the beginning of an outcome period. And let's say a bond, the coupon is known and the maturity date is known. Well, during that 1 year, the bond may trade higher, it may trade lower, and then you will see the yield to maturity. If it's trading higher, yield to maturity will go lower. If the bond is trading lower, the yield to maturity goes higher. But that there's kind of this bogey out there at the end of the year, that here's, we'll get par back, and it's a 1 year outcome. It's the same thing with these ETFs. And these ETFs hold these options that provide that upside cap, the downside buffer. During the outcome period, those options prices are moving, though. And you can see that reflected in this slide that we just put up. This dark blue line represents the performance of the ETF, and the performance of the ETF reflects the value of the underlying options. And so because the value of the ETF will change during the outcome period, that simply means that if you purchased on October 2019, you purchased it up a few percentage points, your performance cap is still 10.6%, but you purchased it up 2%. So you just have a different defined outcome than someone who purchased at the very beginning. If you purchased in October of 2019, again, maybe you have 8% of potential upside. Now you have 2% of downside before that buffer kicks in. And so what we've done is we've built a tool on our website that allows you to come to any of our defined outcome ETFs, and you can know exactly how much upside you have remaining and how much downside buffer you have remaining throughout the remainder of the outcome period. We also have tools that allow you to know, okay, I've got 6 months left in this defined outcome ETF before it rebalances. If the market goes up 10%, what will I get? If the market goes down 10%, what will my client's experience be? These are all tools that we have built. And again, it's because these outcomes can be known prior to purchase because of the underlying options exposure.
Got it. Okay, I think this is an interesting issue here in whether these can be used either as stock alternatives or as bond alternatives, and are they for older investors or in retirement? How would you they're flexible, I know, but how would you what do you have in mind for them?
I would jump in and say, yeah, that really investors could use them for either as a stock replacement or as a bond replacement. For investors who are nervous about equity markets, right, about valuations we saw earlier, about drawdowns, these are a nice way to maintain equity market exposure, but with a measure of downside protection. And then on the flip side, as I mentioned earlier, with bond yields being as low as they are, bonds still do offer the benefit, the value of protection, right? Because of their low correlation, their inverse correlation with equities. Bonds still offer that value. What they don't offer is really a meaningful source of return, at least relative to historical levels. With yields below 1.5% in the ag bond market, investors today are really rethinking their bond allocation. How can they account for these lower expected returns going forward when clients need returns, more like 6, 7, 8, 9%. And so defined outcome ETFs are a way to sort of get the best of both worlds in some sense, higher caps than bond yields, but also with some downside protection. And this side just shows, illustrates how investors might blend their bond allocation and stock allocation with defined outcome ETFs. I think we've got another slide just offering the same thing, right? Whether you're using your bond allocation to shift into defined outcome, or in this one, your equity allocation, we believe both have a place in a portfolio strategy.
And Joe, the only thing that I would just add would be, for more conservative investors, pre-retirees, retirees, using this, we see a lot of advisors use this as core equity allocation. They don't need to match the returns of the market moving forward. They're more concerned about having a level of protection in place against market losses. But then we've also seen a lot of people, like you said, and the chart that you showed, bonds are mapped. And so the yield to maturity is what an investor should expect to receive from their bonds moving forward. So if the yield to maturity is 1.5%, is that really worth it? As we've seen, portfolios lose 3 or 4% from their core bonds just this year. What if rates go up to 4%? People could experience significant losses. Are you getting paid to take the risk? Is 1.5% worth the risk of rates going up 2 or 3% more? And a lot of people are saying, no, it's not. And there's almost the Fed is forcing us to go into equities, but we don't want to be completely exposed. So we want a buffer in place. And so using the buffer ETFs as a bond alternative. Kerry, I think you're on mute.
Yeah, we have quite a few. Can you talk about the availability now of the for just a couple minutes, and then we need to go to Q&A.
Yeah, so the availability, Kerry, is the question with regards to who can access these ETFs, or
well, what's coming up? What do you have?
What's coming up?
Yeah, what's on sale right now?
Yeah, it's a great question. So this slide illustrates, well, I don't know if we ever mentioned, but we offer our S&P exposures on a monthly basis, so that at the beginning of every month, an investor will know they have the opportunity to participate in a defined outcome and achieve a new 1-year defined outcome. And so what we've shown here is our March series rebalanced at the beginning of March and provided investors a new 1-year outcome period. Again, you can see here the 9, 15, 30% buffers. And these were the starting caps for the March series, 17, 11, and 7.8. And it's just some ways we've seen people use it. Coming April 1st will be our April series. That will be, it's already out in the market. And all of those ETFs have actually hit their performance cap. And so what you'll see is, again, these ETFs will simply rebalance on March or April 1st into a new 1-year outcome period. And so one thing to point out is we've hopefully made the ticker convention on these ETFs intuitive. Our March series, MAR, our April series, APR in the ticker, and the buffer is B for buffer, P for power buffer, U for ultra buffer, so that if you were to pull up and just type in that maybe you wanted the April ultra, it's going to be UAPR. So hopefully a way that is easy for advisors to just understand by the ticker alone what ETF they own or which ETF they'd like to research.
Mm-hmm. Okay, well, let's go into the Q&A now, because we have a lot of really interesting questions. There's a couple of questions about the tax treatment of this. We have a question: once I sell the ETF after a period of time, are the gains taxed as capital gains, interest earned, or ordinary income?
So the way that the taxes will work is, if you hold these ETFs for less than a year and a day, you would be taxed at the short-term cap gains rate. Mm-hmm. If you hold these ETFs for more than a year and a day, then you would be taxed at a long-term capital gains rate. So we do not anticipate any distributions to be made with these ETFs. So there's no taxable event prior to when you choose to sell. So again, if you choose to sell, if you hold it for 6 months, short term. If you hold it for more than 12 months in a day, it would be long term.
Okay. Now, there's a question about comparing this to an equity indexed annuity. I think it would be more comparable to a registered index-linked annuity or structured or variable annuity than to an equity index annuity. But can you just briefly talk about the liquidity difference and the lock-in difference and that kind of thing?
Joe, do you want to take that one?
Yeah, sure. And really, a lot of the differences have been mentioned, and maybe the biggest one would be the liquidity. With these, there is daily, intraday liquidity, right? As long as you can trade stocks, you can buy and sell these funds in many cases, right, without even paying commission at some of these online brokers, versus an insurance product where in many cases you're paying a commission fee. Your money is locked up for a given period. You may have a surrender charge. And in many cases, there's no transparency into how the structure is actually, or how the outcome is being built. In many cases, the insurance company is using their balance sheet, which is, it's fine, right? We're not saying that that's bad, but with the ETF, you can actually see inside, see the options that are being held, and see exactly how the product is being, or how the outcome is being constructed. And if you're really an astute options investor, you'd be able to see that the ETF is giving essentially what the market was giving, right? Mm-hmm. And you can know that and confirm that.
Okay. Now now we have a question about the caps, and if there's moving parts here, and I think people are wondering whether is the floor moving or is the ceiling moving above me, and they're curious about now for the entire period, the caps and buffers are the same, right? But the moneyness of the product changes, right? As the ETF, as the index performs, and then you can actually see how much, and this becomes a timing question for people who might want to get out. You can actually see how close you are to, say, running out of cap or running out of buffer. Is that how it works?
Yeah, that's exactly right, Kerry. And Joe, I'm not sure if you can, it's one of those things that these products have been around for so long, but to be able to visualize the performance during an outcome period, and to show that, and a client can. So if here we had a lot of people in February 2020 saying, you know what, I've almost hit my performance cap. Mm-hmm. I might as well lock in that gain, and then maybe I'll roll into the March series, or take that and move into something else. Mm-hmm. And so the caps and buffers are fixed over the entire outcome period. But again, as I mentioned, like the bond example, it mm-hmm. depends where you're purchasing. And the price you pay is going to determine what your defined outcome is. And it just means that your caps and buffers will change. But looking at the screen, the outcome period cap of 10.6 was fixed for the entire year. Mm-hmm. The outcome period buffer 15 was fixed for the entire year.
So if you tried to time this, you'd be defeating the purpose of the product, right?
Absolutely. I mean, we are, for those that are looking to first-time users, we recommend just buy it at the very beginning of the outcome period. Right. We do see people, though, say, you know what, if the market's up 10% and I'm up 6%, that's great. I'm going to lock in my gain and roll into another outcome period. It's not about trying to outperform the market or keep pace with the market. It's simply saying, what did my client need? Did I get it? And then I'll just reset and say, hey, we just rolled you into a new outcome, new 1 year outcome period. Here's what you can expect for the next year moving forward.
Okay, now we have a couple questions about fees. Can you tell us about that?
So all of our equity, U.S. equity exposures, our S&P, NASDAQ, and Russell, are at 79 basis points. And so there are no other fees that we charge with this product. If you're purchasing in the secondary market, just like any other ETF or stock or bond, there's a spread that you pay, but all in for us, we're at 79 basis points.
And that's in addition to the whatever management fee that the RIA might be.
That's correct.
Yeah,
that's correct.
I think they'll be looking at that very carefully, because when you can get an ETF for 10 basis points, then well, you're looking at, 70 basis points as an insurance policy. That's a reasonable. That's a reasonable course to go. Well, they'll have to decide for themselves, but that'll be certainly an option. Let me see what else we have here. Is there counterparty risk of any kind?
Yeah, so I mentioned there's no credit risk with these products. These products are not backed by a bank or an insurance firm. You own the underlying options. And so maybe a high level overview on the counterparty to the options that we own is the OCC, the Options Clearing Corporation. That has been deemed by the US government as a systematically important financial institution. And so in the case, if the OCC were to ever default, which it never has since its inception in the 70s, the US government would step in to guarantee settlement on those options. So that's your counterparty, is really the US government.
Right. Now, just one sort of esoteric question. You said that you buy the at the money option as the first layer. Is that and you said that you get the dividend yield from that? I mean, is that because you don't earn, that you have to budget for the dividend yield at the beginning before you've earned anything? Is that why? Or is it something else?
Yeah, the easiest way to think about it, so it's actually that layer one is a very deep in the money call. So it's not an at the money call, it's a very deep in the money call. So it's the economic equivalent of buying SPY or IVV or any S&P 500 ETF. The benefit though is that you lock in that dividend rate. So what do I mean by that? Well, I mean, you pay $98. So again, assuming, and I've seen some of the comments that 2% dividend yield is actually very generous. We're seeing dividend yields closer to 1.5% on the S&P now.
Right.
But assuming 2%, you're essentially buying that S&P exposure for $98, knowing that if nothing else changes, that exposure is going to be worth $100 a year from now. But rather than just let that appreciate, we use that to buy the buffer. So we take that $2. So if someone gives us $100, 98 is going in for the long exposure. And then we're simply taking that extra $2 and buying the buffer. And that's where the buffer is usually, let's say it's $3. That's when the performance cap comes in. And we'll sell a call at the highest level possible to generate an additional $1 of income to make it a zero cost option strategy.
Okay. We also have a couple questions, and I know that people are used to looking at some of these products and looking in the fine print and seeing that, you're supposed to get X%, but actually it's going to be X% minus the fee. And I think they're curious that is the NAV, do they have to take a haircut from the NAV in order to figure out what their client is actually getting?
Yeah, it's a good question. There's no haircuts. The only thing, as I mentioned, is the 79 basis points, and then any spread that you pay in the secondary market. Obviously, a market maker is going to have to be compensated for providing that liquidity. Now, the spreads that we see have diminished significantly. And so if you're looking at, say, the April series, you're probably going to see spreads of maybe 5 or 6 cents. And sometimes you can get even better than what the spread is on the screen. But we don't take any haircut. There's no haircut of, oh, you want to get out now? Yeah, we'll give you, 99 cents on the dollar. There's none of that. And in a lot of ways, the competitive secondary market, there may be someone who really wants those ETF shares and may be willing to pay up a little bit. And so I think that competition ensures that these ETFs do trade at fair value, and the ETF creation and redemption process ensures that you will see these ETFs, they won't be trading at a premium or a discount to their fair value because of the arbitrage mechanism unique to the ETF structure.
And Graham, a point of clarification there, that bid-ask spread you're talking about, that applies to really any stock you would buy, right?
Any stock or
that.
bond,
Any investor
or any other
incurs that.
ETF.
Right, any other
That's exactly
ETF.
right.
And on this chart too, right, I believe this chart is showing the NAV of the fund, and that is net of fees, right? The caps that are shown are gross of fees. This return, however, is net of the fee because it's removed from the NAV over the year.
Yeah, you can see this one was 73 basis points. So this one came in a little bit lower than the 79 basis point expense ratio. It won't always happen like that, but in this case, the expenses actually came in lower than the 79 basis points.
Mm. We have a question about the costs of, can you have multiple strategies in one ETF? I think people are accustomed to seeing in equity indexed annuities that they can do they can split their money among several indexes. I wonder, but that would be easy here, right?
Yeah, we would simply maybe if you wanted to own the April series and the March series, we see people use a number of our monthly series. And so you can own as many as you would like. They all trade under separate or distinct tickers. And so we see many people owning multiple of these defined outcome ETFs.
Okay, so it's fairly straightforward. You're investing in the underlying assets. It's not like a equity index annuity where you don't own anything of the underlying stocks. You just get an options budget from the general account of the insurance company, and so you own the whole thing, which I guess supports everything else. And then there's the option, you're giving up the dividends, the price of the dividends to buy the insurance, which gives you guardrails at the bottom and at the top. So it's fairly, and also it's liquid, and they can get in and they can actually see where they are in the course of the year in terms of moneyness, if that's the right word in this context. Very interesting product. Very interesting product. Do you want to have any final words for the audience?
Yeah, I mean, from my perspective, and Joe, feel free to jump in. As Kerry mentioned, these are really simple products at the end of the day, that you simply own the market with known guardrails in place. And so whether that's to help communicate a defined outcome to an end client, or looking to add some known risk management in place, there's a lot of different applications, and you can make this as complicated as you want. But at the end of the day, these are very simple, really, boring in the sense that your market's up 40%, you're not going to be at 40%. But if the market's down 40%, you know exactly what type of buffer you have in place. And that's where we feel a lot of investors today, they prefer that option as opposed to being completely exposed to the market.
We have run out of time. We had a lot of wonderful questions, and thank you very much, both of you, Joe and Graham. It's been fascinating. I think we could probably go on for another half hour, but we're going to have to stop here. Thank you, everyone, for attending. RIJ will be doing we're just recently getting our feet wet in the webinar area, and we're going to be doing about one a month. So keep your eyes out for the invitations as they come. Thank you all, and we'll see you soon, I hope.
Thanks, Kerry.
Thanks, Kerry.